All right, we're back for another episode of the Tim and Tim Show, and my lovely co-host is back from his adventures around Europe. What's up, man? How you been?
Good. Almost, although a little inside joke, guys, so can't tell you all of it, but I'm back. But dude, I literally almost went to the cockpit and was like, turn this bad boy around. We're going back to we're going back to Norway.
I remember sending you a text message, hey, you got service? And I was like, you might want to turn around now.
Yeah. Until Sarah was sitting over there and I was like, this is not what I wanted to see the very first thing I checked.
I know. The very first thing I get back stateside and I got service again. The last thing I wanted to see was a text message with, hey,
Yeah,
you got service?
Because guys, I'm sure you guys know, but like when you're going over the ocean, you don't get service. So,
Well, you pay for Wi-Fi? I mean, don't you get the Wi-Fi or does it drop off?
Drops off.
Oh, I had no idea. I mean, I've only been to Europe once.
Yeah.
And it was 10 years ago. So,
yeah. And we were where we were when we flew out of. I didn't even try to get service when we first took off because we were only going to be over Europe for like 15 minutes.
Oh, yeah.
Yeah. So at that point, I was like, I'll just wait till we hit the coast.
Well, I'll go to Italy in like 30 days or so, a little over 30 days for the F1 Monza race. So now I'm prepared. I was expecting to be able to work the whole time on my laptop, but looks like I'm downloading movies.
Yeah. So just in case you want to know, what I tend to do is I tend to do some stuff online and then I have things downloaded that I can work on, like underwriting.
Yeah, right. Oh yeah, fun stuff.
I have things I downloaded that I can work on. But hey, guys, that's not why the one person tuned in. So
yeah, that's right.
Let's
all
check.
Right. So this week, it's even been some conversation in my own head and with some family members and things, and just general people in the real estate industry. And that's why I wanted to make a show about it this week. Yeah, I knew it was Dennis. Dennis is back.
That's my guy.
What would we do without you, Dennis? Yeah. So the question had come up: is investing in real estate in 2025 even worth it? Not going to lie, things have been difficult, and it's no secret. People have been talking about it left and right. It's very apparent in the news right now where, Trump is trying to replace Jerome Powell at the Fed to reduce rates. But, there's conversations on Reddit about like, it doesn't even really matter because Jerome Powell, he's the head of the Fed, but the committee, which contains 12 other members, have to vote on whether they keep the rate the same or they go up or they go down. So just replacing Jerome Powell, the face of the Fed, doesn't actually change or impact if they're going to reduce rate or increase rate. And even if they do increase or decrease rate, what's the real effect going to be on mortgage rates? And my opinion, I know we've talked about this kind of in the extent, is it's not going to make an impact because commercial lending rates, even single family lending rates, they're based off of the treasuries, right? So 10-year and 30-year treasury rates for single family mortgages and the 5, 7, 10-year for multifamily mortgages, right? I mean, they're all based. That would be called, your index is your treasury. Then you have a spread above your indexed. And then the combination of the two is what your interest rate you would pay. So as the rates go up and down and the indexes go up and down and the spreads tighten and expand due to certainty or uncertainty, that's how you ultimately get back to your interest rate, right? And what we've seen, starting in 2022, there was 7 rate increases. The Fed rate went from 0% to 5.5 at one point.
Yeah.
I think, and we've had 2 reductions, maybe 3 reductions or something like that, and we're currently at 4.5% Fed rate. It makes you wonder: is investing in real estate right now worth it? And let me give before we ask Vest's opinion, I'll say my own because I just like to talk. Apparently, I personally think now is the best time to get into real estate. The mistake that we made, not even a mistake, the unfortunate timing of when we started to buy deals in 2022 and 2023, we bought property then and we executed on our value add business plan, but all of the equity that we created in our value adds was wiped out by the increase in interest rates, reduced debt coverage ratios, increased insurance expenses, all of those types of things, right? Those types of things have crushed our pro formas because of things that we couldn't have foreseen. I mean, it was unprecedented the amount of interest rate hikes that went on in 2022 into 2023. Additionally, with that, the increase of the insurance rates at the same time was like a 1-2 punch from Mike Tyson himself on property values, right? And syndicators like Tim and myself, and even property owners, it doesn't matter if you syndicate it wherever your money comes from, you had to perform your value add just to keep up with the increase in your expenses, right? So we had to complete our pro forma income projections just to keep up with where the expenses had gone so that we can trade out the first lien position debt for new first lien position debt. And most people right now are struggling with, they maybe missed their mark. They misunderwrote what they thought that they could get on rents. There had been rent softening across the board. Maybe insurance went up higher than they expected. Payroll has gone up higher than we expected due to inflation and things like that. And ultimately, the NOI has maybe stayed the same even after completing our value add, or even gone down after completing our value add. But at the end of the day, we're still able to thankfully be able to trade out of the loans that were in place. So unfortunate that we bought a lot of property in 2022 and 2023, right? But I'm grateful that we're able to trade out our first lien positions and put on 5-year stabilized debt because the market has gone down, and it's kind of, I hope it's kind of at its bottom. It might stay flat for the next year or 2 years, but we've said it before and I'll say it again, is I think that the market will start to come back up towards 2030. So as we start getting to the end of these 5-year notes that we're putting on these properties, you get to 2030, we start exiting properties and everybody's happy and everybody's making money again. That's why I'm saying it's unfortunate we bought deals then. I'm grateful for the opportunity to be able to, continue to operate these deals and own the properties themselves. But if I were going to tell a new investor now is the best time to buy property because prices have been adjusted for the increase in taxes, the increase in the insurance rates, and the increase in the interest rates with the bank. So your offer is much more substantiated with the market economics today than they were 2 years ago. And that is going to make somebody that has to sell more willing to accept your offer at either break even or a small loss or something like that, just to get out of their deal because your offer is substantiated for lower costs. So we've seen a price readjustment that I think makes real estate today in 2025 and 2026 more appealing to go out and buy as much as you possibly can. Because if we're at the bottom of this cycle and you have a 5-year outlook, the only way I think is up and to the right. Now, I could be wrong. I hope I'm not, but let's hope that things are going to start to turn around. The economy starts to turn around. Maybe there's some stabilization in cap rates and interest rates, and everything starts to come back again. I mean, real estate as a whole has been cyclical, but I do believe that now is the best time to be doubling down on your investments in real estate. What do you think?
So I want to go back to one thing. Quick question for you. Mike Tyson, 1-2 punch.
Yeah.
Jake Paul Mike Tyson or Michael Spinks Mike Tyson? I think.
Yeah.
So
the Gen Zs are going to say Mike. What I just blanked on his name that you just said.
Jake Paul.
Yeah. Yeah, that was a bit of an embarrassment. Thankfully, I didn't pay for that UFC fight and just watched the highlights.
Yeah.
If there were any.
for the younger crowd, you may not remember, Mike Tyson knocked Michael Spinks out in 15 seconds. So it was. I remember watching that fight and was like, well, that was a waste of money. Anyway, so
and ball game's over, folks.
I don't want any of you guys to waste your time on real estate right now. Like, you should all go chase the other shiny object that's out there. Like, go buy Bitcoin, leave the real estate to other people. I don't want you buying it. It's a waste of time.
Everyone's buying businesses right now.
Go buy businesses and Bitcoin and all of that other stuff so that, quite frankly, Tim and I can buy real estate.
I mean,
I
frankly, to be completely honest, we haven't had much competition over the last. I mean, first, when we got into the LIHTC space, very little competition.
yeah,
Second, with most people exiting the market in this wait and see mode of real estate, there's like literally nobody out there to buy deals. So brokers continually bring us stuff and say, "Hey, we heard
yeah,
you're still buying stuff. You interested in this?" I'm like, yeah,
yeah.
maybe at this price.
So, guys, obviously, I'm kind of kidding because in an ideal world, Tim and I would be able to buy everything we want right now. All of you guys would go sit on the sidelines and go look at other things until 2020, 2021 rolls around again, and everybody the investment of the day is real estate. You're all jumping back in and you're competing against each other to buy our properties. That's what I want.
Mm-hmm.
But since we're here and you guys showed up, we'll be honest with you and I'll tell you, yeah, no, this is the time to buy. Been saying it for a while now. Like I hate to admit it, but I kind of prefer this market to 2021 and 22 and 23. When I mean, come on, how many times did we have a property under contract? And if we got to the closing table and something wasn't quite right or whatever, the seller was just like, you're going to close or I'm taking it back out to the market and I'm keeping your earnest money, right? Like
I wish I was on that side of the table then.
Yeah. I mean, it's
But
always
what we're doing now is setting us up for that.
yeah, it's setting us up so that you can be there. But I completely agree with you. I think this is a really good time because I mean, if you think about it, I mean, we say this a million times. It seems like common sense. It seems like people would kind of just have this aha moment. It's like, hey, if your deal cash flows and works at 7.5 or 8%, what's it going to do when it's 5.5%? Right? Like, it works even better. Tim and I are. I mean, Tim, like you're talking about you're talking about some of the stuff we bought. So guys, like, just so you know, like we have even some of the stuff we have right now because of the debt that it's on. When we go refinance, we're going to be able to increase our leverage and lower our payments.
Mm-hmm.
So think about that a second. We're going to borrow more money and have less monthly mortgage payments that we have to make, a lower monthly mortgage payment. And if you have a situation like that where you're able to buy now and it works now, and then you're able to go pull cash out later and even, maybe pay the same or even less. I mean, come on, guys, that's a freaking home run. I mean, that's absolutely the way to do it.
And nothing was even more apparent. I mean, Tim and I are working on a deal right now, and we put some seller financing terms in front of the seller, and I was just absolutely astounded at the amount of cash flow that this property would make, even with the amount of leverage we're approaching it with. But because we offered it with such a low interest rate that it was just, I mean, the amount of money that we had to put down, it was annual cash flow was like 70% on our initial investment.
Yeah.
70% per year, a year and a couple of months, and you get your initial down payment back. Right. And it just, it dawned on, it hit me really hard in that moment because it opened up my eyes to how much more I could pay for a property if the financing was in place, right? If the debt was good, and how much cash flow it increased, right? It was like I was making the comparison, and to have the same level of returns, I need to get $1 million discount from the rate. I mean, from the asking price in order to go out and get bank financing versus if they were willing to hold the paper at a low interest rate and I can close in 30 days. It's like, it's very appealing. And almost everything now that we're offering we're offering some type of seller financing terms. And, and I did rather extensive research, and I put together like a page 2 of explanation of like tax benefits and all this other kind of stuff. And that took me about an hour, I would say. But the effort that I put into that is paying its dividends because the seller is now mostly interested in my low financing rate offer with very low down payment because of the tax impact. And it was literally like a $1.8 million swing in net proceeds after taxes, just because of the way that we were structuring it and the way that they offer it. And they didn't even know that was an opportunity, right? So, Tim and I talk about it all the time. Is real estate worth getting into 2025? Yes. And you got to have a lot of tools in your toolbox. And you got to be throwing all those tools at the different deals, because a JV structure or syndication structure or seller financing structure or seller carryback, there's so many different opportunities out there that if you structure and make a lot of different offers, something is bound to grab somebody else's interest to fit their needs. And I think it might have been lost for a while of trying to provide value to the other side of the table, right? That's how we get so many deals, is because we think about what is their problem and how do we solve it.
Yeah.
If you think of that first and structure something around their problem that benefits you in the long run, you're going to do well. And it's amazing how when you open up your eyes to how many opportunities are out there, depending on what people are telling you they need, you can solve a lot of problems if you have the right network and you have the right mindset when making these offers. I personally think, what's that saying? Pigs get slaughtered, hogs get slaughtered, and what is it? Pigs get fat and hogs get slaughtered, or something like that.
Yeah.
Yeah. It's like, if you try to be a hog all the time, you're going to get slaughtered. But man, if you can continue to be a pig and get fed and make money, base hits, doubles, consecutive base hits and doubles, you're going to come out ahead in the long run.
Yeah. And guys, like, don't take this as like it's going to be easy. It's not. You're still out there. You're getting creative. In fact, you got to be a little more creative right now than we ever had to be in the past.
Mm-hmm.
But one of the nice things is that I think we're able. It's much easier to kind of hold your ground right now.
Yes.
Like Vitaly said, like helping someone solve their problem. And I won't go into too many details here, but we've had a couple of things that we've looked at this year, and it's like, hey, you've got a distressed asset. We're going to help you to solve the problem of getting this off your books and taking over your headache, right? But it's got to be, that's your problem. You need it off your books, and it's a headache, and you're not you're not an operations person. You're not an asset manager, right? That's not your business. We are, and we're willing to take on the headache. So we'll solve that problem for you, but here's the problem you got to solve for us. And there's been a couple of times where, the other side is like, no, I want you to solve this problem, and I want these other two things. And it's like, that's not what we're here for. We're not here for right? Like, you got a problem, we got a problem. Let's help each other out. But there's no and.
Yeah, what's that commercial? Is I want my cash and I want it now.
Yeah. And
great attorney commercial.
Yeah. For instance, there was and again, I'm not going to go into too many details, but there was one where we got into it and it was a much heavier lift than anybody realized, right? So we came back to the table, we started talking about it, and they did come back to the table and say, hey, let's restructure the debt. But when they restructured the debt, Tim and I looked at it, it was like, guys, you're not trying to solve your distressed asset problem. You're trying to solve your distressed asset problem, and you're trying to make another 2 to 3 million in fees. And we're like, not interested in that, guys.
No, it's a good position to be in when
it's a really good
position.
Need it. Yeah. And not only do we not need it, Tim and I look at each other and we're like, there's other stuff out there. Let's just go. If we're going to spend this much money and put this much headache into something, let's go find something else.
It's got to be financially worth it to take on that headache and stress, and it just kept coming back to like, the returns are marginally better than what we would underwrite. Not marginally. They were pretty substantial, maybe 500 basis points higher than what we would normally underwrite to, but with the level of risk and opportunity cost worth 500 basis points.
Yeah.
Probably not.
Well, and Tim, since you mentioned that, like, if you remember, we had gone back and we had said, hey, here's where we need to be. And they said, well, let's see if we can help you on that. Right. And what they came back with, Tim and I are looking at it, and I just kind of went, man, it's the same amount of work, but their offer cuts our profit in half. So we still have to do the same amount of work, but the solution they came back with cuts our reward in half. And I'm like, I'm not interested in doing the same amount of work for half the money.
It came back to the conversation around basis. At the end of the day, there's no replacement for basis.
Right. So, guys, where I'm coming with that is like, hey, there's other stuff out there. Let's go look for that.
Yep.
I don't have to take that right now. This is not the market where I think people need to be greedy. So,
Mhm.
um, you know, I'm with you, man. Like if there's a good deal out there to be had, and we can get creative with it, then this is a great market to be buying in. Quite frankly, I wish I was buying more, but I this is the market to buy. I wish I was buying more, but I'm not going to be stupid in what I buy right
Yeah.
now.
Yeah.
So
I mean, needless to, I mean, but that, kind of rolls into, um, we're we're we want to buy, we want to acquire.
yeah,
We're being very selective. However, we're also not really selling. I mean, we've sold a couple properties now, um, and it was kind of an assessment of, do we want to bear the risk of potentially things getting worse than they are now, or are we going to just kind of cover our bases and get our money out and move on?
right.
What did we sell? We sold like what, two properties earlier this year, three
Yeah.
maybe, and then
Mhm.
we got another one that's supposed to be closing in about a month.
Yeah.
And all of those were protect the downside decisions. We kind of looked at the asset, the location, the cash flow, and the projected returns, and we said, you know what? If we waited another 5 years, the return is going to be marginally better than what it is right now. So let's just get out. We'll make a little bit of coin. We'll put some money back in our pockets, in our investor pockets. We'll protect their investments. The returns aren't going to be as good as we had hoped, but nobody lost money, which is
Right.
good. And now we have the opportunity to redeploy into price adjusted assets today. So we're not really selling a whole lot to realize profits, but we are selling property to protect our downside.
Right.
And one of our favorite brokers, Chris, always says, you sell your dogs in the down market. And I think that's kind of what we're doing. Even Tim Bratz is one of our mentors, and that was we did like a one-on-one meeting with him. He was like, "Hey, every year the bottom 20% of your portfolio that's not performing, that's causing headache and stress, just get rid of it,
Yeah.
because opportunity cost is more expensive than you might realize." So
Yeah.
so we're actively doing that. Some properties we're repositioning and putting onto long-term stabilized debt, and we're just going to kind of sit on it for a little while. It's never a bad thing to sit on an asset that is cash flowing, but it is a good thing to get rid of a liability that's not, right. And JD Crowell, if you're listening to this now or later, you made a really good post about how you got to cut your losses on some properties that are cash flow negative because they're liabilities, they're not assets. And Tim and I have had that conversation, and we're cutting some liabilities where we need to and protecting the downside because they're not assets. And sometimes increases in expenses just can't be covered with increases in the income. So a lot of hard decisions to make. We're not selling by choice. And what that does is, unfortunately or fortunately, depending on which side you're on the table, creates opportunity for other people, right? I mean,
Yeah.
it's cyclical, right? And you gotta be part of that cycle to either to make money, or really at the end of the day. And not every deal is going to be a home run. Hell,
No.
not every deal is going to be a single, right?
Yeah.
But as long as you don't strike out or get hit by a pitch, I think you're doing okay.
Yeah. Yeah. And good point. And Tim, you're kind of being, well, I mean, you're being real, and that's one of the things that I've kind of enjoyed the most over the last, I don't know, 6, 7 months this year. Let's just say this year is I'm starting to see more folks out there. I'm going to preface this real quick. I'm seeing some folks out there calling people out. I don't really care about seeing the calling people out kind of stuff. But I do see some folks out there getting real. I saw some really good posts yesterday and over the weekend where some guys themselves were coming out and they're talking about like what Tim and I are talking about. It's like, hey, I did 30 deals in the last 4 years. I think it's crazy to think that all 30 of those would be successful, right?
Hmm.
And so they're starting to get real about some of that stuff. And so another person that's out there, very, very, very active on social media, she came into the conversation and she was real honest with folks. She was like, "Hey, listen, we put things on hold this year because we have some things that are struggling, and we told our investors, hey, we're not going to buy anything else until we get this solved,
Hmm.
until we get these things solved." So it's kind of refreshing to me a little bit to see, because like when things are going great, everybody's like popping champagne in front of Lambo pictures, that
Mm.
kind of stuff. Like Tim's chuckling because he knows what I'm talking
I know
about.
exactly what you're talking about.
Yeah. Like, and again, not call anybody out, but we saw it. And, it's kind of refreshing to see some other folks coming out there and going, hey guys, I bought 10 deals and one of them went bad, right?
Mhm.
I still got a 90% success rate, but
Right.
one went bad. And it was just good to see the conversation of saying, hey guys, not everything you buy is going to go well.
Mhm.
And that's kind of one of the things that Tim and I have talked about from time to time internally and with some other folks. It's like, I don't know that I trust the guy that says everything I do
Turns
works.
to gold.
Right.
Yeah.
Yeah.
You gotta think though, even when the market was hot in 2021 and 2020, 2020, 2021,
Right.
the deals that people were buying were other people's headaches. So even in an up market, you still have deals that are not working out for you as an operator. And
Right.
yeah, in 2021, you were able to exit it much easier and maybe get out, unscathed or make a little bit of money. You know, uh, but now what you're seeing is if you have a deal that's going south because the market is also down, it's making it much more difficult to exit. But
Right.
the principle does not change that there are deals out there. And when you're buying deals that they're somebody else's headache, right? And you got to go solve that problem and turn that property around with money, really, at the end of the day. What just makes it more difficult now is there's less transactional volume. So if you have
Yeah.
one of those deals in your portfolio, you're not going to be saved by the market because the transaction volume is high.
Yeah. Yeah. And that's part of what we talk about with like the creativity, right?
Hmm.
And that's some of the things like Tim and I talk about. It's like, hey, we got this deal over here it's not crushing it. It's not going great. Hell, it's not going well. So what can we do? Because the market's not going to bail you out right now, guys. Like, like Tim, like you're talking about, like in 21 and 22, when guys were like, I got this deal that's not going well, but let
I'm
me
just
throw it
going
on
to
the
dump it.
market. I'm going to
Yeah.
dump it, and there's probably 10 people that'll buy it, and they'll run each other up, and I'll make a little profit, right?
Right.
No, that's not how this is working right now. So,
Mm-mm.
it's like, hey, what do I have over here that I can get creative with, that I can work with somebody else, and how do we work to solve each other's problems? And that's the kind of conversations like you need to be having right now for anything you got that's struggling. But it starts with kind of being transparent with some stuff.
Yeah. Yeah.
So
Yeah. Absolutely. So.
but hey, at the end of the day, yes, this is a market to be buying in. To answer your original question, I'm completely on board with everything Vitali said at the beginning here. Like, I would be buying. I would love to be stockpiling a portfolio of stuff that I'm going to sell in 2030.
Hmm.
So
Yeah,
yeah,
2030 is my target exit right now,
yeah,
and I'll be 40 in 2030. So that sounds like a good time to wrap it up.
yeah. And hey, guys, real quick, if you got an operator that you're invested with, and they're able to put it on 5-year debt and not ask you for money to refi it or cash in it, and they're able to put it on 5-year debt and you just kind of like ride this for the next 5 years, give your operator a little pat on the back.
Hmm.
In this
Yeah,
market right now, guys, that's a win.
yeah.
That is a win.
It's a hard pill. I'm not gonna lie. It's a hard pill to swallow.
Agreed.
Because the expectation is to make money,
Right.
right? And when you're a passive investor, the expectation is that you will make money. And kind of the argument that I've had is I'm not making money either as the sponsor and the operator. If you're not making money, I'm not making money. But I'm the one that's working 60, 80 hours a week to make sure that you don't lose money, right?
Yeah.
And
Number
that's
one
value.
first rule of investing:
Never lose money.
never lose money.
Yep. Second rule of investing, see rule number 1.
Yeah. So
Um, so the expectation is that you're going to make money, but also understand if the investors are not making money, nobody's making money, right? So that take that as you will, right? But I also like to say is if you own this asset yourself, you would be dealing with these same exact things with nobody to point the finger at, right? And it's nothing that we've done wrong. It's things that we cannot control. The things that we can control, we're in control of. But if you owned say you're an LP investor in a deal and it's not going well, if you own the deal yourself, you would still be dealing with these same exact problems, but
Yeah.
you'd have nobody to point the finger at, and you would be the one responsible for figuring it out. And if you have to put up money or add funds to the deal or anything along those lines, it would be on you, right? So that's kind of the benefit of being a limited partner, is that it's not on you to handle all of those things and handle those problems. Obviously everybody wants to realize the upside and make money, but at the same time, it's always like, hey, let's put the shoe on the other foot and look at this from a different perspective. And when I have that conversation with some people, they're like, you know what, you're right. I've realized, increases in my insurance in other properties that I own, and I'm not making any money there either. And it's like, okay, so then is it unreasonable to expect me to make you money in these deals that you're not making money in your other deals? And then it comes to, it's like, no, that's actually fair. It's like, okay, so then you're not really mad at me, you're mad at the market, and you're just pointing the finger at me. And ultimately come back to, yes, that sounds reasonable.
Yeah.
And it's just kind of learning how to have that conversation and owning it where you need to own it. If you're screwing up and you're not making it happen because of your own negligence, that's one thing. But if it's something that's out of your control, that's an entirely different thing.
Yeah.
So
good point. I like how you turned that.
You like that?
Yeah. So
yeah. So, all right, guys. Well, thanks for joining again. Appreciate you being in tune this week, and we will see you next week. If you got an idea for next week's show topic, something you want us to talk about, drop it in the comments and let us know. But otherwise, if not, we will come up with another great topic to talk about next week. Peace.
See you guys.